Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Leader. Welcome to our special webcast on IFRS 17. Today we'll talk about the publication at the end of June of the amendments to IFRS 17 insurance contracts. And the purpose of this webcast is to give you an overview of the key amendments. The first point in the agenda for today is why the IASB has amended IFRS 17. Then we'll talk about the key amendments. The first one I want to talk about is the new effective date for IFRS 17, followed by the new accounting for insurance acquisition cash flows, the new CSM allocation relating to investment services, and then the substantial improvements that were approved on the accounting for insurance held, which is the cedents accounting, and the risk mitigation option, also known as the VFA hedge accounting. I will be supported today by one of the directors in Deloitte China, Lisa Gonzalo, who works with me on IFRS 17. Lisa will then cover the other amendments impacting several areas of IFRS 17, in particular the one where makes the classification for VFA an individual contract classification. And then so we'll end the webcast by talking about what additional information we can provide you with on the amendments to IFRS 17. So why the IASB amended IFRS 17? Let's remind ourselves as to this particular important point. There were three main reasons. The first one, they wanted to do their part in helping preparers to reduce the implementation cost. How have they done that? The standard has been amended in a few areas by simplifying some of the requirements. For example, there are some contracts to which IFRS 17 applies, which have been scoped out. There has been a simplification on the balance sheet presentation that is believed to be particularly advantageous in terms of systems affecting the working capital of insurance companies. And also there is a simplification of the requirements with regards to the interim reporting of insurance contracts. The second reason was to make results easier to explain to investors. And how they've done that? They've revised some requirements, generating results difficult to explain in some circumstances. This was mainly in four areas. The first one, the accounting for acquisition cash flows was improved to avoid accounting losses that did not match an economic reality. The second one was to fix substantially the way cedents are accounting for insurance contracts held. In particular, the matching of recoveries from insurance contracts and the losses from onerous contracts. Profit recognition was substantially changed to align the accounting of profit from insurance contracts to the multiple nature and the multiple services that may come from those contracts. And finally, when you have complex hedging programs in place, known as a risk mitigation option under IFRS 17, their use is now being aligned to the practices that exist in the most sophisticated markets. The third reason for changing the standard is to ease transition. This has been done by extending the implementation period by 2 years when you measure it to the effective date that was published back in 2017, 1 year extra when you compare to the exposure draft, and also by providing additional transition relief. For example, contracts acquired before transition, risk mitigation option, all these are areas where you see later the IASB has now made improvements to simplify the transition of the first balance sheet under IFRS 17. The key amendments we will cover in this webcast are the effective date first, which has moved to 2023, the insurance acquisition cash flows, the CSM allocation to reflect the presence of investment services, and the insurance contracts held in terms of the recognition of recoveries on day one. Finally, I'll also talk about the improvements on the risk mitigation option, the one that I like to call the VFA hedge accounting. So the new effective date, as I mentioned a moment ago, is now the 1st of January 2023. So we have now this timeline to bear in mind. In terms of the dates already passed, the 1st of January 2019 is the IFRS 9 effective date. Together with the change in the IFRS 17 effective date, the IASB has also agreed to change the deferral of IFRS 9 effective date for entities with significant insurance operations. And so you will remember that an amendment was approved and published in 2017 that brought into the text of IFRS 4 some clauses allowing insurance companies with significant insurance liabilities on their balance sheet to defer, if they wanted, the application of IFRS 9 to the same date as IFRS 17 was effective, the 1st of January 2021. So both timelines have now moved forward by 2 years. So the new effective date and the new sunset clause for the deferral of IFRS 9 are the 1st of January 2023. So that means that the transition date for the opening balance sheet is the 1st of January 2022. IFRS 9 follows in the same parallel shift, and the transition requirements can be found both in IFRS 17 Appendix C and also in the text of IFRS 4 in terms of qualification for the deferral of the application of IFRS 9. The next topic that I wanted to cover is the second key amendment, which is the accounting for insurance acquisition cash flows. This is actually perhaps one of the most pervasive accounting changes that the IASB approved in the new standard. We need to bear in mind that as we were trying to apply IFRS 17 as published back in 2017, a number of discussion in the public brought up the situation where directly attributable insurance acquisition cash flows associated with the issue of a particular group of contracts would have resulted in their accounting to be concentrated in the same period in which those contracts were recognized for the first time. If the commission had been paid with the intent of securing renewals from that new contract acquired in the particular period, you would almost inevitably created an onerous loss position for the first group of contracts, given that the calibration of the commission was for multiple years of contracts being acquired rather than the single first one. So that resulted in a realization by the IASB that insurance acquisition cash flow had to be improved. There was also an opportunity here to codify and implement a better set of guidelines on how those insurance acquisition cash flows that were already allowed to be capitalized as assets in the original version of IFRS 17 should be treated in the balance sheet of insurance companies. And so these amendments cover really two things. A new asset that comes from directly attributable insurance acquisition cash flows, and that is the one that is represented on the diagram in this slide. This is the commission effectively that is paid out of the first original group of contracts, but is intended to remunerate the intermediary for the expected renewals. And so what the IASB has now done is allowing us to capitalize the whole amount and then to allocate the portion of this commission to each of the individual groups. A portion that goes, of course, to the first group where the new contracts have been issued, but another portion then follows to the renewal groups that will be recognized only in later periods. This will be on top of the acquisition cash flows asset that was already allowed in IFRS 17 under the previous text published in 2017. The allocation must be done following a principle, which is the systematic and rational allocation. This will be done on a current basis. So that means that the allocation that has been decided at a particular reporting date will have to be revisited when financial statements for the next reporting period will be produced. So it is always a fresh, current estimate of the allocation of these assets to the future groups of insurance contracts. Each reporting period end, the amounts allocated to the group are revised for any changes in assumptions used in the allocation method, and once all contracts have been added to the group, the assets amount allocated to that group cannot be changed subsequently. So once you get to the allocation box, the one with the dotted line in the diagram, that cannot be changed subsequently when you have revised the allocation basis. So that revision can be done, in other words, only from a prospective point of view. The other important innovation and amendment that comes with this change is the introduction of a clear impairment test on these insurance acquisition cash flow assets. This is required at the end of the reporting period if facts and circumstances indicate that the asset may be impaired. So it is not required to be done all the time, only when facts and circumstances indicate there is a possibility of impairment. If there is a confirmation that such impairment exists, then the impairment loss is recognized immediately in profit and loss. Equally, you will be led by facts and circumstances to a reversal of the impairment loss immediately in P&L with a credit when the impairment conditions no longer exist or have improved. So the impairment then needs to take into account the fact that there are these two portions of the insurance acquisition cash flow asset. The one that already existed, which is the one that is not necessarily directly attributable to a contract, is the one at the bottom of the green bar, the one in light green. That is tested together with the new one, the one that comes from the multi-year commission-based insurance acquisition cash flows, against the expected net inflows that will come from the contracts that will originate from the portfolio. So if these future net inflows are sufficient to absorb the impact of the acquisition cash flows that will be allocated against those net inflows, then no impairment test result is produced and no impairment loss is reported. That is not the end of the test. There is a second step which is dedicated to this multi-year commission-based asset. That is purely focusing on the renewal net inflows. Whilst the first step is done for the portfolio as a whole, group by group, the second one is done effectively by looking at the renewals portion only. And that is to see whether there is effectively a second level of impairment loss to be booked specific to the multi-year commission, which has been brought into the balance sheet as an asset for the first time through this amendment process. The other important change that this amendment has brought is the disclosure. So we have one that is the reconciliation requirement from the opening to the closing balance sheet of the asset, and the typical line items that we will find based on the standard will be an opening balance, additions, the amounts which are de-recognized because you are allocating them to a group of contracts that have been recognized, any impairment losses, and any reversal of impairment losses and the ending balance. In addition, there is also another table that will have to be produced which will contain quantitative information relating to the expected timing of the de-recognition of these assets against future groups. And what you got to do here is to produce effectively time buckets, and then in each bucket to put the amount of the asset that you expect to be recognized against groups that will be accounted for in that period of time. And here you can see an example of a fairly long runoff of allocation for this particular asset, amount that will be allocated within the year, in the next 1 to 3, and so on. So that's helpful then for investors to appreciate how fast the assets will be allocated to the renewals, and also what is the estimate that the management of the company will have put in the particular payment of distribution and acquisition cash flows that they've actually made with that particular distribution partner or other distribution channel. In terms of the final part on the accounting for acquisition cash flows, there is a few bits of news on transition. Now, obviously, for the full retrospective approach, that is the one that continues as before, so always apply IFRS 17 as amended for all the periods as far back as you can, imagining that you had always applied IFRS 17 in those periods. The only difference is in the blue shape on the right-hand side, which is that the restatement of impairment testing is not required for any prior period. So you effectively restate the asset already correctly for the amount that is going to be recoverable from transition date going forward, and you do impairment only from the effectively from the first balance sheet of the comparative period, 2022. In terms of the other two restatement approaches, on the modified retrospective approach, we use the same allocation method for the acquisition cash flow occurring pre-transition period as that used after transition date. And when there is no reasonable or supportable information to make the allocation, then the standard indicates that a nil amount is recognized at transition date for the adjustment to the CSM of groups that are recognized at transition date, and any acquisition cash flow assets related to that group, and the acquisition cash flow asset for groups of insurance contracts that are expected to be recognized after transition date. I'll be curious to see in practice how many companies that when they reach the point of impracticability, they will actually have a modified retrospective approach and the conclusion of no reasonable and supportable information leading to the nil amount. Because the alternative, as we know, is to move straight into the fair value approach, in which case you always recognize an asset on the grounds that the fair value will indicate what the entity would incur at transition date if the entity had not already paid those acquisition cash flow to obtain the rights to A, the recovery of the cash flows from premiums of insurance contracts originated before the transition but not yet recognized at transition date, so effectively future business from the 1st of January 22 perspective, and B, obtain future contracts, including the expected renewals after the transition date without paying again insurance acquisition cash flows the entity has already paid. In our own analysis, we believe that the fair value approach is likely to always generate an asset balance on transition. And so our expectation is that most of our clients that will reach the point of impracticability will either apply the MRA having reasonable and supportable information or move into the fair value approach. The next key amendments I want to talk about is the CSM allocation relating to investment services. For direct participating insurance contracts under the variable fee approach and for indirect participating insurance contracts under the general model, the CSM allocation is now based on coverage units determined considering the quantities of benefits and expected period of both insurance coverage and investment services. So now we have a recognition that a number of insurance contracts are multi-service contracts and the profit recognition in the financial statements must be aligned to that multi-service nature that the contract has. The cash flows within the contract boundary is an important point here. Inclusion within the fulfillment cash flows of costs the entity will incur relating to performing an investment activity that will enhance benefits from insurance contracts and costs for provisions of investment services. So this is effectively an important amendment that will deal with those situations where you don't have a direct participating contracts or an indirect participating contracts, but you may still be doing activities that will enhance the benefits of your insurance contracts in terms of the amounts that you are paying out to the policyholders. In that instance, the projected fulfillment cash flows must take into account the cost of conducting those enhancement activities, in other words, the cost of investment asset management activities. Finally, there will be additional disclosures. In particular, insurance companies will be required to describe the approach used to assess the relative weighting of benefits provided by insurance coverage and investment services in the relevant portfolios of insurance contracts. Looking then at how there is the approach to determine the coverage units for indirect participating contracts, we have some additional guidance coming through the amendments, and that is the definition of an investment return service. This is something that was not already available in the original text of the standard, unlike the definition of investment-related activities for the direct participating contracts under the VFA. And so this is the new definition. The investment return service is something that will exist when all of these three criteria are met. The first one, the contract contains either an investment component or the policyholder has a right to withdraw an amount from the contract. Two, such component or amount includes an investment return. And three, the entity expects to perform investment activity to generate such return. Fairly intuitive, but very important, and it is the combination of the three of them all together that actually identify the presence of the investment return service. When I look back at the previous slide, you can see that the cash flow boundary modification is now necessary because you will end up in certain situations, for example, annuity contracts, without an investment component or without a right to withdraw an amount from the contract with failure in the first of the three criteria. That means that that contract will not have an investment return service if it is not a VFA. And that means that you may end up leaving out from the fulfillment cash flows the cost that you would incur to provide an enhancement to the annuity payout that the customer is entitled to receive for as long as he or she is alive. And that's why the cash flow change was necessary. It's effectively for those contracts that are paying out only life contingents payout. Moving then to the next key amendments, this is about the recovery of losses from underlying insurance contracts through reinsurance contracts held. And this is a very significant improvement of the accounting for insurance contracts by the cedent, the buyer of insurance contracts. The key point is that there is a recognition of a gain in P&L at initial recognition if the insurance contracts held are entered before or at the same time as the onerous underlying contracts are recognized. And that loss recovery is calculated at an amount which is the multiplication of the loss recognized from the underlying reinsured insurance contracts and the percentage of claims on underlying insurance contracts expected to be recovered from the insurance contracts held. The standard also explains that where a reinsurance contract held covers only a portion of the group of underlying insurance contracts, so in this example you have 3 sections, A, B, and C, only the contracts under the portion called B in this group of contracts is covered by reinsurance. In that instance, the standard will require the use of a systematic and rational allocation method to determine the portion of losses of the onerous group that relates to the underlying insurance contracts. Then moving to the risk mitigation option. There are some additional risk mitigation option instruments that are going to be permitted and also some additional transition provisions. Overall, I felt that this is an area where substantial improvements have been made in the standard. So let me walk you through the 3 key elements of these improvements. The first one is about the instruments that can be used for these hedge accounting. We started in IFRS 17, originally published only to have derivatives as the possible hedging instrument to be used in the VFA hedge accounting. And now, with the amended version, we also have reinsurance contracts held and non-derivative financial instruments, as long as they are accounted for at fair value through profit or loss. So we have now a very broad range of hedging instruments that can be used to mitigate financial risk in this portfolio of variable fee approach contracts. In terms of the transition, two points to bear in mind. The first one is that in order to address the concerns from stakeholders that those hedging programs have been in place for many years, but they are not allowed in terms of the hedging instruments to be restated on transition date, the IASB has now introduced a very radical approach to restatement in this particular instance. So you get to the point of transition balance sheet on the 1st of January 2022, and then you can use the fair value transition approach for a group of contracts that are effectively part of this hedging relationship if the specified criteria are met, which is effectively related to the fact that you have met already in the past the conditions for the VFA hedge accounting, and those conditions are in existence on the 1st of January 2022. So at that point, bearing in mind that your derivatives and your non-derivative financial instruments are fair value to P&L have already accumulated net gains or losses in equity as a result of fair value gains or losses booked in the prior periods, we'll have a contra recognition in the opening equity from the VFA hedged item because of the fair value approach. So in other words, the CSM will be determined by reference to market participants' perspective, and the cost of guarantees at that point will be fully fair valued on the opening balance sheet, therefore mitigating, we believe, at least to a very substantial extent, the potential accounting mismatch that would have arisen if the fair value approach was not applied to the hedged item of the relationship. The other point is less impressive, but when IFRS 17 was published, the transition for the risk mitigation option was on the effective date. So you would have effectively not restated the comparative. This has now been removed, and effectively the full transition on retrospective basis is now being pushed back to the transition date, 1st of January 2022, under the new regime. And so that means that the financial statements with the 2 columns will reflect fully in the 2 columns the effect of the risk mitigation option. In terms of the transition, I wanted to further elaborate on how this is going to work. So here you can see hopefully a helpful diagram that shows you how the transition mechanism are going to work when you have the use of the fair value approach. So you have a group of direct participating contracts, that's your hedged item, and you can then fair value it if and only if the entity can apply IFRS 17 retrospectively, so it is not an impracticability point, but more importantly, the second and the third one are key. You can choose to apply the risk mitigation option to the group prospectively from transition date and has used qualifying risk mitigating instruments to mitigate financial risk arising from the group before the transition date. If all these conditions are met, then the significant amount of time that it goes from the initial recognition date of the group of contracts that are effectively the hedged item in the relationship will be restated on transition date using the fair value approach, and then you use normal accounting from transition date going forward. So that's the point in time when you have the application of normal accounting. Now, this not only has got the benefit of reducing substantially the accounting mismatch between the hedging instruments and the hedged item, but also the presence of a much simpler transition approach using the prospective fair value measurement for the hedged item than it would be required under the full retrospective approach. With that said, I'd like to hand over to Lisa to take you through the other amendments in IFRS 17.
Thanks, Francesco. So there are also several minor amendments to IFRS 17, and we have selected some amendments to highlight in this webcast. First of these minor amendments is the revision in the text of paragraph B107 of IFRS 17, which aligns its requirement with that of paragraph B101, making it clear that the requirement of performing the eligibility assessment for variable fee approach is at an individual contract level and using expectations of the entity at the inception of an individual contract. So this amendment is a clarification on the recognition of contracts into the group it belongs to. The amendment provides a clarification that insurance contracts are added to a group when these contracts meet recognition criteria set out in paragraph 25 of IFRS 17, regardless of when these contracts were issued. This means that groups will remain open to new contracts being added beyond the 12 months that bound the group time span. So, for example, an insurer issues a profitable contract in 20X1 with no cash flows occurring at the time of issuance and assessed to be included in the 20X1 cohort group. This issued contract has a forward starting coverage of 1 January 20X3 with premium being due also at that date. Applying the amendment, such contract will only be added into the 20X1 cohort group in 1 January 20X3, which is the date it meets the recognition criteria set out in paragraph 25 of IFRS 17. The practical implication of this amendment is that a group will remain to be open until such time that contracts issued but not yet recognized during the 12 months that limit the group time span have all been recognized. This amendment relates to the accounting for pre-recognition assets, liabilities, and cash flows other than insurance acquisition cash flows. With this amendment, an entity is required to include in the initial measurement of the contractual service margin of a group of insurance contracts the effect of the derecognition of any asset or liability previously recognized for cash flows related to that group and accounted for before that group is recognized. For example, premiums that have been received in advance of their due dates and prior to the recognition of the group of contracts they relate to will be derecognized on the initial recognition of the group they relate to and then included in the initial measurement of the contractual service margin of the related group. An amendment was also made in the analysis of insurance revenue disclosure requirement. Amounts such as the experience adjustments for premium receipts relating to current or past service will be disclosed as part of insurance revenue, and a special disclosure line item is now required in the footnotes. In the next two slides, we also included additional selected minor amendments. The IASB has amended the definition of investment component to make it clear that an investment component is an amount that an insurance contract requires an entity to repay to a policyholder in all circumstances. The phrase "in all circumstances" was not previously included in the original wording of the definition. So, if the insurer can avoid the repayment of an amount, that amount cannot be part of an investment component. The clarification has explained that if a policyholder lapses a policy and loses the right to receive a repayment, then this amount cannot be treated as an investment component because there is a circumstance where the insurer is not obliged to repay it. Also, the definition of the liability for remaining coverage and the liability for incurred claims have been expanded to include all obligations arising from insurance contracts. The expanded definition provides a much clearer guidance that other obligations in an insurance contract, such as a refund of premium to a policyholder or the payment of an investment component, are included as part of the insurance contract liability. The scope of IFRS 17 is amended to exclude credit card and other similar contracts that provide insurance coverage from applying IFRS 17. However, their insurance component is required to be unbundled from the host financial instrument and accounted for applying IFRS 17. An optional scope exclusion is provided for loan contracts that transfer significant insurance risk. In terms of presentation requirements, the presentation requirement for insurance contract account balances in the Statement of Financial Position has been simplified such that the determination of insurance contracts that are in an asset position and insurance contracts that are in a liability position is performed at the portfolio level. A number of minor amendments relating to the measurement requirements of IFRS 17 has also been made. The IASB provided clarificatory guidance to make it clear that changes between the expected and actual repayment of an investment component or loan to a policyholder are excluded from the adjustment to the contractual service margin because they relate to the time value of money and financial risk. Income tax payments and receipts that are specifically chargeable to the policyholder under the terms of an insurance contract are now included in the fulfillment cash flows. Changes resulting from cash flows of amounts lent to customers, such as a policyholder loan, and waivers of amounts lent to customers are excluded from insurance revenue. When an entity prepares interim financial statements, an accounting policy choice has now been provided with regards to the treatment of previously reported accounting estimates. An entity is now provided a choice of whether to change or not to change the treatment of the accounting estimate it has made in the previous interim financial statements in the subsequent interim financial statement or in the annual reporting period. This choice is made at the reporting entity level.
Thank you, Lisa. So we're coming now to the end of our webcast, and I want to share with you that there is additional information available from Deloitte if you want to know more about the amendments to IFRS 17 before embarking yourself in reading the whole of 140 pages of it. We published an IFRS in Focus dedicated to the amendments to IFRS 17. This document is under 20 pages, and it provides a sufficiently detailed discussion on the recent amendments, explaining how they're going to be impacting recognition, measurement, disclosure, and presentation requirements within the standard. It is effectively released in parallel with this webcast as a tool that hopefully will help our clients to grasp the changes that will impact their implementation work for IFRS 17. And as always, I remain at your disposal. My contact details are displayed on the slide. You can follow us through social media channels if you prefer them, LinkedIn, Twitter, YouTube. The webcast will be available there, as well as in our dedicated website at www.deloitte.com/i2ii, which is Deloitte Insights into IFRS Insurance. Hopefully the webcast today was useful for you to appreciate the content of the amendment passed by the IASB on IFRS 17, and with me saying thank you for your participation, together with Lisa Gonzalo, is look forward to speaking to you again in another webcast in the near future. Goodbye.